Hey, ma, the islands. Just sometimes your life, just a Jamaican, you crazy man. Well, come and join me out here in the islands. Why, get my feet up and the breeze blowing through my hair, man. Aye, what you do is take and invest some money into the stock market and then come retire with me out here in Jamaica, man. Alright, you guessed right. Today we're going to be talking about the stock market. Alright, so gambling for investors. The stock market is not the safest place to invest your money. You can make it big so you could retire out in Jamaica, or you could wind up losing everything you have. So, it does have the highest returns for your money. Um, a return is the amount that you gain or lose by your investment. Okay? So you invest money into a stock market or into a stock, and then that stock will either make you money or lose you money. Variations in the stock market happen minute to minute. You're talking about a stock could be up. You could, let's say you invest at 8 o'clock. That stock could be up $20 by noon. And you're like, oh man, that's great. By that evening, before the market closes, say by 3 o'clock, man, something major happens. That stock crashes, and now you're down $20 per stock. And say you bought the stocks for $25 a piece, you bought 100 stocks. Well, all of a sudden, so you put in $2,500. Well, now you've lost $20 on every stock. So you've lost $2,000. So that's how quick it can turn around. Now, that's kind of an extreme example, okay? It doesn't usually jump 20 points up and then 20 points down or whatever. Um, but it does go minute to minute. It could be up one part of the day and down another. And the more you risk, the more you can win. And there's a lot of variations on how to do this. And you can see, people watching, stock tickers and various things. All right, the past. How did stocks come about? Stocks are a share in a business. Shares entitle you to a share of the company, of its profits. Okay, so you have a part of this company. Now, if you have a stock in a company, depending on how many stocks this company has or whatever, you have a small share. Before you really are going to notice a lot or have much say so, you need a lot of stock. Stocks were first used after the agricultural revolution began to show ownership of commodities. This would be like a granary, okay, a silo that they would keep grain in, and they would fill it up, and then they would give you these kind of things that would show how much of this granary belonged to you. I would come and deposit my grain in here, and I would get something that would have various marks on it saying, okay, well, I have, let's say if it was this one, 2, 3, 4, 5, I have 5 clicks of, whatever that would represent, uh, of grain in here, of that is mine. And so it would show how much I owned in that, and it's totally grown and changed since then. Going public. If you ever watch a movie or hear a company or something talk about an IPO, that is the initial public offering. This is the first sale of a stock to the public. If a company never had stock out to the public before, and then it comes out and says, okay, we're going to sell a bunch of our stock out to the public and get public investors, that is its IPO. That's a big deal for a company. Companies sell stocks to raise money. They can do this in order to grow. Let's say I'm a shoe factory and I want to open up a boot factory. I'm just doing so well with my shoes. Well, I want to open up boots. So I'm going to do an IPO. So I sell some of my stock off. So I get enough money that I can now open another factory and start selling booze as well. This has pros and cons. The pros, it's money without taking loans and publicity from being on the stock market. People start realizing, catching their name of your company. The cons, you now don't own all of your company anymore. You become a partial owner. Your company is now more regulated because it goes under a lot of more rules. And all your files and so forth become a lot less private because you now have partners who own part of your company. Stockholders. Okay, these are some terms here. Stockholders is a person who owns a share of stock in a business. A dividend is a share of a company's profits to its shareholders. Okay, if I own a stock in Walmart, I would earn dividends on the amount of stock I own based on how much profits they're making. Capital gain. It's an increase in the value of an investment that gives it a higher worth than the original purchase price. Let's say, I was a genius way back when, and I invested in Apple when it first came out. All right, boom. I've had a huge capital gain because Apple has just, you know, gone crazy. It's way up there. Um, and there would be a huge capital gain. Board of directors. These are people who are elected by stockholders to run a company. The stockholders vote on the board of directors. These are the people that it's going to have and say, hey, we want you to make sure that our investment is being well managed. And the stockholders also get quarterly and annually reports on information about the company. Okay, and this is we're talking about it being less private. A lot of this information gets sent out to your stockholders and to your board of directors. This is like if you see it in a movie a lot of times. This person might own the business, but yet they might have started it and own it pretty much, but they answer to a board of directors. That's because uh, they are a publicly traded company, and they do have stockholders who have elected a board of directors. Depending on the number of stocks and how much you own, you may only want a very small portion of the company and its rights to its profits. If you own 1% share, well, don't expect that you're going to get a whole lot. Uh, Now, if you own 50% shares, then you're going to actually see, some significant, depending on how much profit the company's making, you're going to see significant dividends. However, if you own 1%, you're not really going to get much. Okay, you do not make money if the company does not make money. So even if you own 75% of the shares, if that company didn't make any money, you're not making any money. You do not get to tell the company what to do unless you own that huge 50%, over 50% of the shares. Okay, because then you would own majority of the company, and if there was a vote, you got yours carried more weight. And you see this happen in movies sometimes. Everybody's trying to buy up and get to that specific number of shares so they can control the company. Um, and then you do not get special discounts with the company either. Let's say I own, 100 shares of Walmart. I can't go up, bust up in Walmart and be like, yeah, I own this place, suckers. Now give me my discount. Yeah, I take it free. No, that doesn't happen that way. Private versus public. Private company. The ownership of the company is entirely in private hands. It is not traded on the public market. Owners have full responsibility for the company. Okay, remember, and this is back where you can go back and see where we were talking about the different responsibility levels. And you can lose personal belongings if it doesn't do well. If your company goes, into failure, then they can come and seize your assets. A public company, a company that has offered stocks to the public in an initial public offering, that IPO. The company stocks are traded on the public market. They are regulated by the SEC, the Securities and Exchange Commission. Okay, the SEC. Uh, they report its financial information. It's set up as a corporation. Okay, as a business owned by stockholders that is a legal entity with rights to buy, sell, and make contracts. And with that, you have limited liability. You can only lose what you have invested into it. Types of stocks. There are common stocks, which is a stock that represents ownership in a company, also called ordinary shares. Preferred stocks. These are a stock that represent claim of ownership in a company and has a higher claim on assets and earnings than common stock. And then market capitalization is the company's outstanding shares multiplied by its share price. And it's broken down into nano, micro, small, mid, large, and macro cap stocks. Okay. The innards of the stock market. The stock market does not really exist. Okay. It is an electronic global network that people buy and sell shares over. You can't just walk into the stock market, unless you're like Neo or something, and then all of a sudden you can be like, Bzzz! Whoa. So the stock market doesn't really exist. Now the stock market goes in cycles. There's a bubble, which is the high end. It goes up on a bubble, and the bubble can burst. And that's why it's called a bubble. It can burst, and things can come crashing down. And a crash is the low end. You can see up here, kind of here's the bubble, and then it crashes and starts coming way on down. Uh, Variations of the market. There's the primary market. Investors have the first opportunity to buy a newly issued share. And then there's the secondary market. Investors buy and sell shares from each other. Okay? Like if I came to you and I said, hey, let me buy you shares of Walmart you got because I want my free stuff. And you say, okay. And you sell me your shares of Walmart, that's a secondary market. Stock exchange is a place where buyers and sellers of stock markets meet and agree on a price for trade. Now, this is a physical, real place. The stock market, not real. Stock exchange, real. Okay? And these are these things you see on TV, like right here, all these people standing around and they're hollering, and they're throwing up fingers. And if you saw me, I was just throwing up fingers in the air and wave them like I just don't care. But they're hollering out, and I got no idea how you keep up with all that because that is crazy. Um, there's auction market, stock market where buyers and sellers enter competitive offers simultaneously. They're all offering for over the stock, and whoever winds up with the best price wins. And then over the counter markets, a stock market where trades occur over a network electronically, such as the Nasdaq. All right, the broker, your friend. A broker is an individual or a firm that executes buys and sell orders. They requested by an investor for a fee or commission. Okay, so if you're going to invest, you might want a stockbroker who is going to buy and sell for you because this is what they know they know what they're doing. Whereas if we went and looked at the numbers ourselves, it's like I don't know what that means. And then there's two types of service of stockbrokers. You have a full service broker, which is a broker that provides a wide variety of services to customers, including investment research and advice. And then a discount broker, which is he's much cheaper than a full service broker. But he handles buying and sell orders at a reduced commission, but doesn't provide the advice for you. Okay. So if you feel like you're good enough to do it all on your own, pretty much, you can do with a discount broker. If you think you need help, then you want the full service broker. And nowadays they have the stuff online so that you can do a lot of the trading yourself. Um, Goals. Before you play the stock market, you need to figure out what your goals are. Okay, two basic goals: secure and steady income that will grow. And this is your short term that you want to a value stock. It's a valuable assets owned by its company, cash and real estate, and a high dividend yield. This means you want to invest some money and you want to grow it, and you want to do this kind of rapidly. And then there's to get high potential earnings. This is more in the long run, um, which is growth stock. That the potential increases in the price of the stock lead to capital gain. Like if I want to invest long term, let's say if when you first start getting your job, you want to do some of this long term investment in order to uh, set up for your retirement. Now you can do some short term to increase some of your money, but you want to go for some of that long term investment, which some of it tends to offer some risk because there are ups and downs with it, but usually in the long haul it will wind up. And you usually you do want to do a mixture of both. Um, and then there's socially responsible investing. People who get across their political or social agendas with their investments. So if you don't believe in what this company's doing, well, I'm not going to invest in this company because they're doing animal testing. So I'm gonna go invest in this company, or I don't believe in this, so I'm not going to invest in this company. And so that's known as social responsible investing. And then there's two ways to analyze of how a company's doing: fundamental analysis and technical analysis. Fundamental analysis focuses on a company's specific traits and on general economic conditions to understand the behavior of a particular company stock. Basically, they look at the company itself to see how this company is doing. To see how well the stock's going to do. If this company's doing good, if all these things are happening in the company, then its stock should increase. Or technical analysis, they focus on the activity of the stock market. They look at how the stock market's doing and how this company is going to fit within the stock market to guess of how the stock is going to do. So until next time, deuces.